There's been so much talk of gold hitting astronomical new highs, whether it's $10,000, $20,000 or even $50,000. But it's seldom considered what the consequences of such price action would actually be. Today we take a look at whether we really would want to see $10,000 gold. So let's dive on in. Now, this channel provides global macro insights for informed investing, so do consider subscribing. The key points we'll investigate in this video are highlighted just here on the screen. So first, let's understand what gold really is. Gold, after all, is a long-term store of value, an asset which is globally renowned and respected for its monetary characteristics and ability to preserve and store wealth in the face of crises. It offers no yield, as it simply is seen as money which has been used for millennia. As former Fed Chairman Alan Greenspan stated, "I view gold as the primary global currency. It is the only currency, along with silver, that does not require a counterparty signature." In contrast, fiat currency depends upon the creditworthiness of a counterparty. Now, the first means by which we could see gold hit extraordinary new highs would be via an orderly monetary reset and movement towards a partial gold standard system. This would require an acknowledgement by policymakers and authorities that our current era of fiat currency has failed. Moreover, it would require a willingness to act before confidence in the dollar standard completely fails. Jim Rickards has become one of the most vocal proponents of such a step and outlines the process as follows in his book Aftermath, stating that the US, China, Japan and the Eurozone have a combined M1 notes and coins money supply of $24 trillion. Those same countries have official gold reserves of over 33,000 tons of gold. Historically, gold standards have operated at around 40% backing. So 40% of $24 trillion is $9.6 trillion, which gives rise to a price of over $9,000 per ounce. Now, using broader measures of the money supply would obviously give far higher prices for gold. But the crucial factor with such an orderly approach to gold revaluation and currency devaluation is to set a non-deflationary price that restores confidence but does not lead to or perpetuate a depression by suppressing money supply to a low gold price. An alternative approach is that the Federal Reserve could become a buyer or seller of gold at a certain price, say around $9,000. If the price moves beyond this, they would sell gold and thereby increase the market gold supply. If the price is below, they would print currency to buy up gold reserves until the price attains around that $9,000 mark. So what sort of consequences would we see on the economy of such an approach? After all, nothing happens in isolation. Well, the loss of confidence in the dollar standard would certainly see gold prices rise, while the dollar would depreciate significantly. This would give rise to increased inflation as confidence in fiat paper declines, but undertaking this approach prior to catastrophic impacts upon the population as at large would be a bold decision. Yet we know our central banks love to appear to be our saviours, our knights in shining armour. What's more is that we know how crises can be used to introduce reforms that our authorities deem necessary. I cannot see central banks freely opting for such a move. Instead, they prefer to kick the can down the road. And after all, gold is the competitor to central bank money, and most central banks would prefer to ignore gold. Yet central banks in the aggregate are net buyers of gold, as we've discussed many times on this channel. So as Jim Rickards has put it, that in effect central banks are signalling through their actions that they are losing confidence in their own money and their money monopoly. They're getting ready for the day when confidence in central bank money will collapse across the board. In that world, gold will be the only form of money anyone wants. And so what about a disorderly approach? Well, this would lead to far more serious consequences for the economy and its citizens. This would include a plummeting dollar leading to significant inflation. The fiscal deficits and soaring national debts would give rise to major solvency concerns for the economy, as well as other developed nations as well. Fiat currencies globally would plummet in value, and this would precipitate a rush towards gold and a massive spike in demand, which would see prices soar. Moreover, this would be large enough to multiply the current size of the gold market by 5 times. In such a circumstance, the demand for physical gold would almost certainly bring down the COMEX futures market, and ETF products that rely heavily upon paper gold would be greatly vulnerable. And such a gold groundswell would see silver prices surge, and with a mere market size, the proportional rise in silver prices is likely to be far greater than that of gold. And geopolitically, such a massive rise in the gold price would hand nations such as Russia, China, as well as Turkey enormous influence on the global stage, while countries short of gold reserves such as Canada and the UK would likely see much diminished roles. If we also look at the experiences of Greece and Cyprus, who have faced sovereign debt crises, we can see that it has catastrophic effects on the banking sector, which leads to the so-called ICE 9 impacts, where the banks close and there's enormous restrictions on the availability of people to actually regain their finances. Now, we can actually use some more technical indicators to anticipate the wider consequences of the gold price soaring if we use Alistair MacLeod's gold price model. Now, this is based upon real forward 10-year Treasury bond yields and the oil prices, which have tended to be key indicators for the price of the yellow metal going to all-time highs. To achieve a $10,000 gold price, we may need to see real bond yields at around minus 15% and oil prices of perhaps $400 or more per barrel. Thus, inflation would be in double digits, and we would see even greater societal unrest. In trying to avert the sovereign debt crisis, the Fed may have expanded their balance sheet to well beyond 100% of US GDP, causing a dramatic decline in the dollar. But other factors may also be apparent, including the fact that further precious metal demand could be stimulated by the introduction of CBDCs, compromising people's right to privacy and their ability to transact freely and anonymously in cash. After all, freedom to own gold means freedom from inflation, freedom from currency devaluation, freedom from banks, and freedom from digital surveillance. Moreover, truly significant inflation may see debts revalued according to the new currency reset, and this could give rise to far slower, poorer quality long-term growth prospects in a stagflationary environment where inflation and unemployment remain stubbornly high. Yet Dan Oliver offers a slightly different interpretation towards high gold prices, as he puts it. The market will soon discover that much of society's wealth has become entrapped in non-cash flowing malinvestments. Tax revenues will plummet, and the assets that our central bank holds will be shown to be near worthless. That is when gold will shoot into the multi-thousands of dollars per ounce. And what of our central bankers? How would they feel about a return to the gold standard? Well, here's Greenspan once again. Today, going back onto a gold standard would be seen as an act of desperation. But if the gold standard were in place today, we would not have reached the situation in which we now find ourselves. We would never have reached this position of extreme indebtedness were we on the gold standard? Because the gold standard is a way of ensuring that fiscal policy never gets out of line. So we know authorities will do all they can to avoid reintroducing a gold standard, but it remains a viable means of regaining confidence and reducing the real size of national debts by devaluing the currency against gold. So what do you think? Do we really want to see $10,000, $20,000, $50,000 gold when it has such serious ramifications for the wider economy, and particularly for those that do not hold hard money assets? Let me know what you think in the comments down below. Now, do make sure you check out these other videos so you can understand more about the silver and gold market, what lies ahead in the coming decade. Here's our summary for today. Thanks so much for joining me, and I look forward to seeing you next time. Bye bye.